Hey everybody, this is Alex Merced, and you're listening to Mastering Financial Exams. As an instructor here at Greco Financial Training, I want to make sure that you know what you need to know so you can pass your exam, whether it's a Securities Industry Essentials exam, a Series 7, a Series 24, and that's why we're doing this show, Mastering Financial Exams, on iTunes, Google Play, Stitcher, and Spotify. Now, in today's episode, we're going to do our final foray into sort of equity-related products, and that product is called a REIT, a Real Estate Investment Trust. Now, all a REIT is you're buying shares of a real estate company, but the way it's usually structured is you'd basically buy a bunch of real estate, you'd raise a bunch of money by selling the stock, you'd buy a bunch of real estate, you'd hire a management company to manage those properties, collect the rents, that kind of thing. And at the end of the year, you would take all that money that you got from all the rents, from people that people paid who lived in those properties, or all the interest you collected if the company decided to buy a bunch of mortgages. But you would take all that money, pay the management fee to the management company for managing the properties, and then pretty much everything that's left over gets paid as a dividend to the shareholders. So really what at the end of the day, what a REIT does, it just takes big blocks of real estate and passes the cash flow straight through to an investor. So that way they can generate real estate related income without having to do all the work of managing the property themselves, of having to go collect rent and fix up a broken dishwasher and all that stuff. And what makes it even better is long as the company invests 75% of its money in real estate and real estate related investments, then it gets treated like a mutual fund in the sense that long as it pays out 90% of its profits at the end of the year, it's only taxed on the portion that it did not pay out. So if a REIT generates $100 million of profits at the end of the year, long as it pays out $90 million as a dividend to its investors, who will then pay taxes on that dividend, the company, the REIT, only has to pay taxes on the remaining $10 million that was not paid out. Now, there are two types of REITs. There are equity REITs, and whenever you hear that word equity, you think ownership. So equity REIT means they own properties. So they own properties, collect rents from those properties. And then there's a mortgage REIT. Whenever you hear the term mortgage, you think loans. So they buy up a bunch of mortgages from the local banks and then collect interest and principal payments from those mortgages, and that's where they make their money. Now, what if you do both? Then you're called a hybrid REIT because you buy properties, collect rents, you buy loans and collect interest and principal. And overall, very cool investment vehicle for getting exposure to real estate and generating dividends. Unlike other real estate vehicles, this does not give you a monthly income like a mortgage-backed security, which we'll talk about at another time. It does not allow you to get tax deductions like a real estate limited partnership, which we'll talk about at another time. But a REIT is liquid. It trades on exchanges. It does pay sizable dividends every year because it's paying out 90% of those earnings, and it gives you exposure to real estate. So my name is Alex Merced from Greco Financial Training. Hopefully you guys enjoyed this episode. Make sure to leave a review over there on iTunes, Google Play, Stitcher, and go check out Greco.com. Enroll in one of our full online courses so you can get all the features, all the lectures, all the stuff to help you pass your exam. I'll see you guys next time. Have a great one.